everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, independent financial advisor and owner of Elevation Financial. As always, thanks for joining me. Glad you are here today. We're talking investment management today. What is investment management? That's what we're going to talk about today. What is it? Investment management is something that many, if not most, financial advisors do for their clients. Managing investments is a big part of what I do as well for my clients. It's part of an overall financial planning engagement, and it involves handling investments like IRAs, Roth IRAs, the investments inside of them, consulting on 401ks, solo 401ks, all sorts of different vehicles and containers, brokerage accounts. These are all containers that hold investments. And inside of those containers, the investments are really kind of what is the fuel behind the performance, the behavior of these accounts. Different accounts have different tax sheltering status, different tax features, and so investment management inside of those accounts is part of it, as well as I consider investment management the consulting on the most appropriate types of accounts, how to use those accounts as well. So there may be some overlap, some gray area here. Some people in a very pure sense would consider investment management just, choosing investments inside accounts and limit it to just that. And they would say that financial planning is actually the consulting on account types and usage of those accounts. I would say it's a little broader than that. I consider investment management kind of a whole package. But again, there's different opinions on that. But just for my purposes, I consider investment management kind of a broader picture. So I'm going to talk through what is investment management today. There's a couple of reasons for this. One is I just think it's good information, good to help people in general understand what their financial advisors might be doing, or if they're doing it themselves, what investment management might entail, what goes into it. And also just to kind of just open up the mysterious world of what we do a little bit. Some people think investment management is this, mysterious, magical black box, and it seems very difficult and strange, and it's really not that difficult or strange. It does take some skill and some persistence and some knowledge and some process, and some things kind of go with it. But I do like to unpack the details of it so that it's easier for people to understand in general, because I like it when people are informed and understand what's going on with their money. I think that's most important. So let's talk about what is investment management. So whether you're doing it yourself or whether an advisor's doing it, here are some things I consider investment management and what they mean and what they do. So first of all, choosing and monitoring investments. This is probably what most of us would start with. Hey, what is investment management? Well, it's choosing the investments that go inside your accounts and monitoring those investments, potentially making changes if necessary. So there are over 10,000 different mutual funds and ETFs available out there. Obviously, there's tons of stocks as well. There's a lot of options, or there are a lot of options for investing. It can be overwhelming for some. And, often the part of investment management most people think of is, hey, I need to just choose what to invest in. What do I do? That's kind of the basic form of what most people think of when they think of investment management. Now, there are lots of choices, but there are some very mainstream popular choices from large fund companies that are some of the most, the largest and most popular funds that people choose in general. So there are some that kind of rise to the top in terms of very commonly chosen or very popular mutual funds or ETFs. But in general, there's still, a lot of overwhelm there for some people. So choosing and monitoring investments, that's kind of the basic starting point of investment management. Next, avoiding investment selection allocation mistakes. This is fairly common as well for people to think of. They think, investment management is, determining my risk profile based on, things like time horizon, when I need to use the money, my preferences on investing, and the allocation of your investment will be driven by those factors. Allocation is things like, hey, how much is in equities or stocks? How much is in fixed income or bonds, alternatives, etc. So that allocation decision ideally should be based on specific financial facts about your life. Again, things like time horizon, when the money needs to be used, other factors in your life that kind of tell a story about your risk levels. And so Avoiding allocation mistakes can take the form of, hey, if someone is more appropriately invested in a more conservative allocation, but they choose all equities, which is extremely aggressive, or vice versa. Maybe they are, very young, they have plenty of time, they won't be using the money for 30 years or so, but they choose an investment portfolio that is extremely conservative, which would be inappropriate for them and possibly result in them missing out on long-term returns. So avoiding allocation mistakes, in my opinion, is part of investment management. And that's something that if you're doing it yourself, you want to be aware of and kind of really understand allocation. But if an advisor is doing it, they're also going to be very mindful of determining your risk profile and then allocating appropriately to that and keeping it up to date. So as life goes on, you get older, you get closer to the time when you might be using that money. That's when allocations may change over time. Next, part of investment management is rebalancing. This is fairly simple. I'm not going to overcomplicate it, but rebalancing is bringing your portfolio back into its intended allocation. Portfolios can drift. So even in the course of a year or so, depending on volatility in the market or the way certain assets grow and certain don't, you can end up with an allocation that has drifted out of range of what you originally determined. And so rebalancing can bring that portfolio back into balance. So for example, if your preferred allocation is an 80-20, 80% equity, 20% fixed income, then and it drifts to maybe more of a 90-10 because equities have performed or have grown faster than fixed income, which is fairly common, then you might want to bring it back into balance. It's appropriate to kind of keep your risk profile in line with the allocation. The allocation can be rebalanced to be brought back into range. So this is fairly, again, it's fairly straightforward. The mechanics of it can look different. So if you are in a custodian that requires manual rebalancing, you would have to kind of manually do the sells and buys to kind of bring it back into balance, a little bit high maintenance. But a lot of custodians now let you click a button or they even auto rebalance for you. So that's something that is not super complex, but it is something that is important to at least be aware of and understand if your rebalancing is happening and when it's happening and why. Tax loss harvesting is another thing that is part of investment management. Tax loss harvesting involves taking investments in your accounts that have generated a loss, maybe have decreased in value, and selling them and then replacing them with investments that are similar but not the same, therefore avoiding what's called the wash rule. I'm not going to get into the wash rule today, but basically there's a way of you can sell investments that have lost value and capture a tax deduction based on that. You can basically offset gains with some losses and reduce your exposure to capital gains taxes. So tax loss harvesting is a way to be very tax efficient and make use of those losses to capture a tax advantage or a tax efficiency. That's something that I shouldn't say most. A lot of people aren't aware that exists, and a lot of people don't understand how to do it. But investment management that's part of investment management overall for many people that would gain some value from capturing those losses and using it as a tax efficiency kind of feature. Tax gain harvesting is something that is also available to many, and tax gain harvesting involves selling investments that you want to kind of activate the capital gain on it, but you're in a tax bracket where there would be no capital gains or perhaps lower capital gains than you normally would be in. So if you have a year where, let's say you normally make high income, but you have 1 year for whatever reason where your income is lower, then at that point, you can do what's called tax gain harvesting, which means you would capture the gain and then you would be able to capture that gain, and it would not reflect as a capital gain in that particular year, and therefore you're kind of locking in the gain without paying for it. So that's one way of using investment management to create tax efficiency. Facilitating Roth conversions as well. That's something that is fairly common for many. Roth conversions involve taking pre-tax money in traditional IRAs and converting it to a Roth. just kind of a recap on pre-tax versus Roth. Pre-tax means you get a tax deduction up front, you pay taxes later. Roth means you're paying taxes now, but you get tax-free growth, and using the money later is tax-free. So a lot of times it makes sense to capture more tax-free growth, and Roth conversions means taking that pre-tax money, converting it to Roth, paying taxes on it at that point, and then enjoying that tax-free growth later. So a couple of things go into the logistics of this. One is just knowing when to do it. That's part of it. Part of it is also the paperwork or the administrative functionality of making it happen. Sometimes it's a form you fill out. Sometimes it's a DocuSign. Sometimes it's stuff you fill out online on a Custodian. A lot of different ways to do it. So it can be a little tricky for some. So investment management involves knowing how to do Roth conversions and facilitate that. Along with that, facilitating backdoor Roth IRAs, along with the Form 8606 prep. So backdoor Roth IRAs are a loophole in the tax code. It sounds sketchy, but it's perfectly legal. And it allows high earners who would not normally be able to contribute directly to a Roth IRA to get money into a Roth IRA in a roundabout fashion. You basically contribute money to a traditional IRA, and then you turn around and convert it directly to a Roth IRA, and you don't take a tax deduction on the contribution. You just basically send it directly over to the Roth. And that allows you to still contribute to a Roth IRA, but not doing it directly, therefore not encountering the income limit you would normally encounter. There is some paperwork to file along with that. So along with the logistics of making it happen, there's also the paperwork of the Form 8606, which is you need to file along with the conversion for that tax year to document that contribution and conversion. So there's kind of a little bit of paperwork involved, a little bit of nuance. So part of investment management is facilitating those things, in my opinion. Prepping and filing Form 5500 for solo 401k plans. This is a little bit niche, a little bit specific, but in managing investments also, you may have some paperwork to go with that investment account if it's a solo 401k. Solo 401ks, if they reach a certain level of assets or the plan needs to be closed or other reasons, then you need to file what's called a Form 5500, which is Department of Labor requirement to report. It's an annual reporting basically on that plan. It's not difficult, but it's also not super easy or intuitive. So you have to kind of know how to make that filing happen. Also, aligning investments with client values and SRI and ESG research and implementation is also a part of this. So this is not true for everybody. I mean, I have plenty of clients that don't have an interest in socially responsible investing or aligning with progressive values, and that's totally fine. But I have many clients that do. I have a specialty in this area, and many clients do want their investments to be aligned with progressive values, and they want the advocacy component as well to encourage companies to be better global citizens. So there takes a lot of research to go into this. There is a fairly complex and nuanced landscape of socially responsible investing. And that does take research and knowledge and implementation. So part of investment management is monitoring the available options with socially responsible investing and implementing those options as well. So that is part of investment management. Also, facilitating corrective actions, things like removal of excess IRA contributions or Roth IRA contributions, things that maybe were errors and then need to be corrected. So one good example again is, someone expects their income to be X, and that X is under the limit for Roth IRA contributions. So throughout the year, they make direct Roth IRA contributions. Some event happens or some miscalculation happens, and oops, their income is now over the limit, and they realize that. Well, you have to process a removal of excess contribution to kind of back it out and be back in line with IRS guidelines for contributions. Move it to a taxable account. So there's some paperwork that happens behind the scenes to make that happen. That's part of the management. Also, aligning asset allocation with client time horizons and risk profile and keeping it up to date. I kind of mentioned this before, but just the ongoing monitoring of, hey, things change in your life. Your risk profile may change. Obviously, age is a factor, but also things like income, insurance status, other situations, family life changes. These all can be factors that may affect your risk profile, and keeping that aligned with your asset allocation is important. Keeping management of custodian paperwork and administrative details. That's kind of an overlooked part of investment management, but there's a lot of paperwork and admin details that go into just dealing with custodians. I'm not going to name any big custodians, but you know who they are, the companies that handle the money, that hold your money, hold your investments. So account management of custodian paperwork is, again, kind of overlooked, but it can be a pain, quite honestly. Pretty much every day I am in communication with custodians to process paperwork, to, check on the status of things, to, follow up and correct what's called a NIGO. And NIGO stands for not in good order. It's kind of an acronym that is used in some custodian circles to say, this paperwork didn't go through correctly. There's some weird error and you got to correct it. And, just being on the phone and on hold with different custodians. So, the administrative minutia of managing custodian relationships can be a lot sometimes, depending on your situation. So I consider investment management to include that sort of account management. Keeping investments organized is part of it. Just simply saying, hey, you know what? We've got 17 different accounts and custodians out here. It makes sense to consolidate them and simplify. And that can be part of the management, at least initially, of organizing and simplifying and keeping track of all those accounts. Income planning also, when you're in retirement or when you're at the point where you're actually using the money you saved up, income planning, like which accounts to pull from, which order, understanding that income planning piece of it is part of investment management. Also, maximizing tax efficiency in investments. Part of it is understanding what types of investments go into which accounts for tax efficiency. For example, this is not a one-size-fits-all rule, so don't quote me on this for every situation. This is a broad educational example, but often it makes sense to put certain types of things like mutual funds into retirement accounts because they're tax sheltered, and often in brokerage accounts that are taxable accounts, it often makes more sense to use other types of funds like ETFs, for example, and direct indexing with tax loss harvesting. There are ways to make those accounts more tax efficient. And you have to understand which accounts behave in certain ways from a tax standpoint so you know how to be as tax efficient as possible. And last on my list, finally, again, this is probably not an exhaustive list, but I'm going to wrap up here with one final thing, which is avoiding behaviorally and emotionally driven errors. This is arguably, I think, the most important out of all of it, quite honestly. And it's the most ethereal and difficult to pin down in a tangible way, but helping people avoid errors that are driven by emotions and fear often can be extremely valuable. So if you're DIYing your own investments, you just have to understand how to manage that fear and manage that behavior. If an advisor is helping you, that advisor's job is to help you manage that emotional context around decisions. So again, one great example we're seeing, especially right now, at the time of this recording anyway, is the market is down year to date, and a lot of people are scared. A lot of people are saying, well, my investments are going down. I hate seeing the value of my investments decrease. I'm going to just sell everything and go to cash and just wait it out for a while. Well, that is for many, that is what I would consider an error in investing, because you are locking in losses, you're pulling out of the market. It's very likely that you will miss the recovery when it happens, and you will not experience the performance and the gains and the returns you would have experienced had you stayed invested. So that's one great example of where an advisor's value comes in, is to help you kind of just talk through, hey, I understand you're scared. I understand things look kind of concerning right now, but here is a perspective that will help you stay invested and drive decisions that are in your best interest, not driven by emotion and fear, but driven by facts and a process and a proven plan. So I shouldn't say proven plan because we can't guarantee the future, but a plan that is reliably constructed, I should say. So again, I think it's hyper important to understand that part of investment management truly is managing the emotions around investing to avoid errors that can be detrimental to your financial future. So those are some things that go into investment management. Again, not meant to make it sound super complex and scary and difficult, but also meant to really showcase and highlight the value that goes into what is investment management. Investment management, to some, may seem simple. To others, it may seem complex. Generally, the truth is somewhere in the middle, in my opinion. There are some complexities to it, but there is some simplicity to it. And I like keeping things on the simpler side. My bias is towards simplicity. So those are a few things that go into it. And again, especially the logistical stuff, but especially the behavior-driven part of investment management is something that can be most significant and most beneficial to really understanding when it comes to managing your investments. So again, a large part of what I do is investment management, especially on the SRI and ESG side of it as well. But those are some of the nuances, and I hope that's kind of shed some clarity on your understanding of what investment management is, at least in some part. So with that, as always, you know where to find me. If you'd like to reach out and talk about this or anything else, you're welcome to reach out via my website, which is elevationfinancial.com. And there's a button on the homepage if you want to click that button and book a complimentary money session. You're welcome to do so, and I'd be happy to chat about this or anything else that you might have questions about. As always, thanks for joining me today. Have a great day. We'll see you next time.